European stock markets are a vital barometer for the global economy, serving as a real-time reflection of the continent's financial health and the interconnectedness of global trade. Every tick of the market tells a story, not just about the companies listed, but about the hopes, fears, and expectations of millions of investors, business leaders, and policymakers. These markets are more than just numbers on a screen. They are living, breathing entities that respond instantly to news, rumors, and shifting economic winds. They reflect the fortunes of corporations, the confidence of consumers, and the impact of government policy in real time. When a major company posts strong earnings, optimism can ripple across the continent. Conversely, a disappointing report or a sudden policy change can send shockwaves through the markets, affecting everything from pension funds to small investors' portfolios. On November 6, 2025, these markets faced a day of high drama and volatility, driven by a flood of mixed corporate earnings and global uncertainty. Investors woke up to a barrage of headlines, some promising, others deeply concerning, creating a sense of unease and anticipation. The mood on trading floors was tense, as every new data point or breaking news story had the potential to swing sentiment from hope to fear in an instant. Major indexes like the Stoxx 600, DAX, and FTSE 100 swung sharply as companies reported both triumphs and setbacks, with some sectors outperforming expectations while others struggled to keep pace. Analysts scrambled to interpret the numbers, searching for clues about the broader economic outlook. The volatility was not limited to a single industry. It was a widespread phenomenon, touching everything from technology to manufacturing and banking. Meanwhile, central bank decisions and U.S. trade policy loomed large, casting a shadow over the day's trading. Investors kept a close eye on statements from monetary authorities, looking for hints about future interest rate moves or stimulus measures. At the same time, ongoing trade negotiations and diplomatic tensions between the U.S. and Europe added another layer of complexity, making it even harder to predict where the markets might head next. The interplay of earnings, monetary policy, and international politics pushed most European markets into the red by the closing bell. For many investors, the day ended with more questions than answers, as losses mounted and uncertainty lingered. The closing numbers told a story of caution and concern, highlighting just how sensitive markets are to the complex web of factors that drive them. In this video, we'll break down the day's key events, spotlighting major companies, central bank moves, and the global forces shaping investor sentiment. We'll explore how individual earnings reports, policy announcements, and international developments combine to create a perfect storm of volatility, and what it all means for the future of Europe's financial markets. By understanding these dynamics, we can better grasp what this turbulent day signals for investors navigating Europe's financial landscape. Whether you're a seasoned trader or just starting to follow the markets, gaining insight into these forces is crucial for making informed decisions in an ever-changing environment. November 6th ended with European markets firmly in the red. The Stoxx 600, tracking 600 top companies, dropped 0.7%, signaling broad-based selling. Germany's DAX fell 0.58%. The UK's FTSE 100 lost 0.56%. And France's CAC 40 slipped 0.32%. Spain's IBEX 35 tumbled 0.7%, while Italy's FTSE/MIB edged down 0.26%. These declines reflected widespread uncertainty, with disappointing earnings and global caution prompting investors to pull back. The day's losses set a pessimistic tone, leaving many to wonder what's next for Europe's financial markets. The message was clear: risk-off sentiment dominated across the continent. Diageo, the global spirits powerhouse behind iconic brands like Johnnie Walker and Guinness, has long been seen as a symbol of stability and success in the beverage industry. With a portfolio that spans continents and a reputation for quality, Diageo has weathered many storms over the years, consistently delivering strong results and rewarding its investors. But this week, the company delivered a shock to the FTSE 100, sending ripples through the financial world and catching many by surprise. Diageo slashed its full-year outlook, citing unexpectedly weak demand in both China and the US, two of its most critical and lucrative markets for premium spirits. The slowdown in these regions is particularly concerning, as they have traditionally driven much of the company's growth and profitability. On top of sluggish sales, US tariffs have added another layer of pressure, with Diageo now bracing for a potential $200 million hit to its bottom line. These trade tensions have made it even harder for the company to maintain its margins and keep prices competitive. Investors wasted no time reacting to the news. Diageo's shares tumbled by 6.5% in a single day, a dramatic drop for such a well-established blue-chip stock and a clear sign of shaken confidence. As a heavyweight in the FTSE 100, Diageo's sudden plunge dragged the entire index lower, amplifying concerns about the health of global consumer spending and the broader economic outlook. The warning from Diageo was unmistakable. Even the most established industry leaders are not immune to shifting consumer sentiment, economic headwinds, and escalating trade tensions. The landscape is changing, and companies must adapt quickly or risk falling behind. For investors, this was a stark reminder of just how quickly fortunes can change in today's volatile global market. It's a wake-up call that even the giants can stumble, and that vigilance and adaptability are more important than ever. Amid the gloom, DHL Group stood out as a rare winner. The German logistics giant beat earnings expectations, showcasing resilience despite global headwinds. DHL's shares soared 8.6%, making it a top performer on both the Stoxx 600 and DAX. However, CEO Tobias Meyer cautioned about declining U.S. trading volumes, echoing broader concerns about the American economy. The message: strong results today, but volatility ahead. DHL's story highlighted the market's hunger for good news, while reminding investors to heed warnings about future uncertainty. In a turbulent market, even bright spots come with caveats. AstraZeneca provided a much-needed boost, reporting a 10% jump in quarterly revenue and beating analyst expectations. Shares rose 3.1%, a standout gain on a down day. The company reaffirmed its growth outlook, but CEO Pascal Soriot warned of potential headwinds in China, Latin America, and from U.S. policy shifts. AstraZeneca's performance underscored the value of strong fundamentals and global reach. Even as markets wobbled, demand for innovative medicines remained robust. For investors, AstraZeneca was a defensive anchor, proof that quality companies can thrive amid uncertainty. The lesson: resilience and strategy matter, especially in volatile times. Commerzbank delivered a mixed bag this quarter, surprising investors with a 7.9% drop in net profit, largely attributed to a one-time tax effect. This unexpected result caught many off guard, especially given the bank's recent efforts to streamline operations and improve efficiency. The tax hit, while non-recurring, was enough to overshadow some of the progress made in other areas of the business. Shares fell 2% in response, weighing on the DAX and fueling broader concerns about the health of the European banking sector. The market's reaction was swift, with investors questioning whether this was a sign of deeper issues or simply a temporary setback. Yet, beneath the headline numbers, there were signs of resilience. The bank raised its full-year net interest income forecast, signaling underlying strength in its core lending business. This move suggests that, despite the headline miss, Commerzbank's fundamental operations remain robust, and management is confident about future earnings potential. The market, however, focused almost exclusively on the profit miss. This highlights how negative surprises, even if technical or short-term, can easily overshadow positive fundamentals and long-term improvements. Commerzbank's story this quarter revealed the complexity of financial results, where technicalities, accounting adjustments, and one-off events can drive sentiment and shape investor perceptions, sometimes more than the actual business performance. For investors, it was a timely reminder to look beyond the headlines and dig into the details. Understanding the context behind the numbers is crucial, especially in a sector as intricate as banking. Even solid core performance and positive trends can be eclipsed by a single negative number, especially when it comes unexpectedly. It's a lesson in how quickly sentiment can shift. In banking, perception often moves faster than reality, and the true story is often found in the details that don't make the front page. While most sectors struggled, German defense contractor Rheinmetall held steady. Despite slightly missing sales estimates, the company posted a 20% jump in operating profit, fueled by surging demand for weapons and ammunition. Ongoing geopolitical tensions and NATO rearmament drove a flood of new orders, boosting Rheinmetall's margins. Shares finished flat, an achievement on a down day, reflecting investor confidence in the sector's stability. The defense industry's non-cyclical demand made it a rare point of stability. For investors, Rheinmetall's resilience highlighted the growing appeal of defense stocks in uncertain times. Central bank decisions were another key focus. Both the Bank of England and Norway's Norges Bank held interest rates steady, signaling caution amid persistent inflation and recession fears. The Bank of England's move, ahead of the UK's autumn budget, was widely expected. Bond yields fell, and the British pound strengthened, as markets interpreted the steady hand as a sign of stability. Central banks are in wait-and-see mode, watching data before making their next move. This cautious stance reinforced the market's hesitancy and contributed to the day's negative tone. For investors, it was a reminder that monetary policy remains a critical and unpredictable market driver. European trading was shaped by global forces, especially developments in the US. Hopes for a US Supreme Court ruling against Trump-era tariffs buoyed some sentiment, as a rollback could boost global trade. Wall Street's previous gains and Asian market rallies offered early optimism, but couldn't offset Europe's wave of negative earnings. The day underscored the importance of stock-picking companies like AstraZeneca and DHL thrived, while Diageo faltered. For investors, the lesson was clear: focus on quality, resilience, and strategy. The market's tumble was a product of disappointing earnings, cautious central banks, and global uncertainty. Navigating this environment requires diligence and a sharp eye for strong fundamentals. In turbulent times, only the best prepared companies and investors will weather the storm.